All right, why don't we go ahead and get started, because some people might hop on and hop off throughout this. So thank you guys all for coming. For those who don't know me, my name is Rick Albert. I am a real estate broker with America Real Estate, as well as a mom and pop investor, so to speak. I have a couple rental properties, been house hacking through. Today we have John Kim of Guaranteed Rate. So thank you for being here. One of the things, we've done this before, we did this back in kind of like, was it March-ish? And so the idea is maybe to start doing this, every quarter or so. This is being recorded. So just so everybody knows that, we'll eventually post this on YouTube, Instagram, all that fun stuff. If you have any questions, feel free to put them in the chat and we will get to them. The format today is I had sent questions to John. John sent questions to me. So we're going to answer some of those questions because those are some of the questions that we're hearing clients ask us. So we just want to make sure that we're the best prepared, and that's why we wanted to have this conversation. So why don't we go ahead and get started? I'll start with interviewing you, John, and then we'll throw it in reverse, and then we'll do the Q&A. So why don't we get started? What's changed in the mortgage industry since we last spoke back in March?
Well, I mean, to be honest with you, I think that not much has changed in terms of lending, but the analysis as to like self-employed people, that is going a lot deeper nowadays.
Okay.
If you're like a salary W-2 type of worker, it's pretty much business as usual. But the self-employed people, they're going to have to jump through a little bit more hoops to kind of prove that their income hasn't been affected for COVID. So in particular, it gets a little complicated, but at the end of the day, before profit and loss statements weren't needed for regular conventional loans, but now they are. And then also business bank statements to ensure that the deposits are matching the revenue that they should expect in comparison to the tax returns that they had prior. So basically, if you're like in the month of August, you're 8 months into a 12-month, year, the amount of profit that they want to see year to date would be the same profit that you made on your tax returns in August of 2019. So, and then the 3 months of bank statements or 2 months of bank statements, depending on the situation, it's just making sure that that cash flow is still coming in. So there's kind of a more analysis that has to go through for self-employed people. Rates are super good. The Fed is still basically helping people to have confidence that they're not going to let the economy fail. So at the end of the day, rates are still below 3, and then jumbo rates are slightly higher just because they're not being backed by the Fed. But it looks like the economy's not as bad as people may think. And it was the first time, I think, was it yesterday, that unemployment came below 1 million. So yeah, it's but pretty much business as usual, I would say.
Got it. So if someone's self-employed, the big thing is they just need to prove that they're basically maintaining the same income that they had prior to COVID.
Exactly. Yeah, and that's that's the analysis that between the tax returns that was taken in 2019 to year-to-date profit and loss, and the bank statements that you have to come in with to make sure the cash flow is still there. If all three of them are matching, then that's the best case scenario, or increasing. But there may be more questions, and if it's declining or you don't see that cash flow still coming in, that's where self-employed people are starting to because the question is has COVID affected your business, right? Typically for a salary W-2 employee, as long as you have pay stubs, you're showing that you have that cash flow. But for self-employed, it's the game has gotten a little tighter for them.
Got it. So outside of those that are self-employed, are banks getting stricter, right? Because what was it, towards the beginning of this whole pandemic, Chase was like, nope, nothing less than 20%. So are there any programs where they are getting more, is it becoming more difficult for investors, first-time home buyers, anything like that?
No, I would say not. So, well, at least for us as Guaranteed Rate as a company,
Sure.
I know that some banks, particularly like Wells Fargo, like if you want to refinance a jumbo loan, like you have to like have $1 million in the bank. That's what I've heard. But no, the lending requirements have not really constricted that much as I mean, as far as I can tell. I mean, I'm still pre-approving people the same way we used to.
Right.
Yeah, it's actually a little bit easier to qualify people too, because with a lower rate is a lower payment. Lower payments easier to qualify.
Which
Type
means higher
of
price points,
exactly, yeah, for
which
sure.
in
But
high cost areas like LA, that's beneficial.
exactly. And I would say, the 3% down for first-time home buyers, at a particular loan limit, at the conforming limit, basically below a 500,000 loan amount, that's still out there. The only thing that I would say could be constricted is sometimes I get a lot of questions is down payment assistance programs.
Mm,
Those have kind of been suspended for the most part. There's some out there that will still do it. Um, and then even like HELOCs are starting to come back now. So the ones in second position,
that's right. They put a pause on those for a while, didn't they?
yeah, they did. And like for example, if you're not familiar, like an 80-10-10 is basically you come in with 20% down payment to avoid MI, but at the same time you take out a HELOC to get you put down your own 10%, but then the HELOC puts down the remaining 10% for a 20% down payment.
Right.
So basically, you have a first and second loan. The HELOC is a second position loan. Those were suspended for a long time, and now it seems like they're coming back too. I wouldn't say that it's the rates are probably not going to be what you would have expected, pre-COVID timeframe, but at least it's available now.
That's good. It's definitely a plus from before.
Yeah, for sure.
Right. So, okay. So that all makes sense. So the big thing right now, I'm having conversations with a lot of buyers, and they're concerned that the market is just like it was in 2007, 2008. And I get it. I can see why that might be a concern. So what's different between what's happening now versus what we saw in 2007, 2008 when it comes to qualifying, when it comes to appraisers, anything like
Yeah,
that?
I mean, to be honest with you, I haven't really seen that many appraisals come in below value, and maybe that is a testament to the real estate agents who are making sure that the listings aren't going sky high, rocketing out of control, where the appraiser is saying that there's nothing incomparable around in your neighborhood that has sold for higher than X amount, and you're selling it for X plus, 500,000. So maybe that's a testament to that. I think the biggest difference maybe that you could probably take away is that, '08 it was a blindside. It was a right hook to the back of the head. Nobody really saw it coming. I think that maybe the lessons that were learned in '08 may have been um, seriously applied here in this situation where the credit requirements and the Fed and Fannie and Freddie and FHA, they've all really, really just got their heads together, figured out what they wanted to do to ensure that foreclosures were going to skyrocket out. And I have to imagine that those lessons learned from '08 was the reason that they were able to move so quickly now. So um, yeah, I mean the massive foreclosures that happened in '08, I don't think you're not seeing that
Right.
at this moment in time. And for what they're doing now, they're ensuring that's not going to happen for the people who are in escrow now.
Right. And even then, interest rates are much lower. Like I have a client who recently refinanced. He did a cash out refinance, got 50 grand into his pocket, but his payments went down by $8 a month.
Yeah,
So
yeah.
he's like, I'm paying less and I have 50 grand in the bank. Versus in 2008, people were over leveraging themselves.
Oh, totally. Like I just completed a cash out refinance an investment property, and typically that's the most expensive of all transactions. Uh, to to only take cash out, that's an expensive transaction, but to take it out against not your primary but an investment property, that's even a more expensive proposition. And even that rate wasn't really that bad at all. If you would have done it pre-COVID, it'd probably be above 5%, but this one was right around, 3. So it was exactly what you're saying. I think the one thing that maybe is a source of frustration for maybe a lot of people who are in escrow right now is the mortgage industry is basically maxed out. Escrow companies are maxed out too. The amount of loans that are going through the system is just phenomenal. So everybody's pretty much backed up is really the case.
So how are you guys? So on the refinances, you have a little bit more time because there's no like contingencies. so to speak. So on the purchase side, especially with, I would imagine a lot of people are still working from home on the mortgage side. So how are things still able to move so quickly, or are they just that much? Are they slower? Like what's going on in that respect?
You know what's so funny is that like guaranteed rate, I mean, as far as my company, I can't speak for others, but
Of
I mean,
course.
they've worked remotely now for, for since the outbreak, and we haven't really seen a difference in performance in terms of longer turn times, because everything was pretty much paperless from the very beginning. Everything that we get is digital regardless. It's very rare. I would say maybe 1 out of 20 bars who actually have to mail things in because they're not comfortable with the technology.
Hmm.
Those transactions always take a long time, regardless if you're in COVID or not. But like you said, at least for guaranteed rate, we're not like the minimum lock times right now we're doing for refinances is very long, because you have to put the purchases in front just to make sure that.
Explain. Sorry, I didn't mean to explain the
Okay.
lock times, just for those that might be listening and don't know exactly what that means. Are you talking about like you're rate, like locking in a interest rate, right?
Perfect. Yeah. Yeah, you're exactly right. So, just ensuring that that rate is going to stay the same always has a time limit on it. So, the moment you lock, you're basically the lender is under the clock to basically close out your loan. We've extended those lock times basically to ensure that we're going to put refinances, second place to a purchase because a purchase, there are hard line contingency timelines that have to be met in order to meet contract requirements. And everybody's involved, right? The seller is demanding it, the buyer is demanding it, the agents are demanding it, and I mean,
Sure.
by law, we're demanding it too. So, yeah. So I would say purchases, if there's a 30-day escrow, getting a 30-day escrow close is still not a problem at all. But refinances are taking longer, that's for sure, because the purchases are being prioritized.
The priority. Sure. And then for those that are in forbearance, I know when we spoke a couple months ago, it was, we almost like said everyone's financial situation is different, but if you go into forbearance, the risk is you're gonna have a balloon payment at the end of the 3 months. What's changed now with the forbearance program for those that own their homes?
Well, so like we have this situation going on with a couple files that we have. People are in forbearance, but the rule is right now is people have put it in forbearance not necessarily because uh, I think they just were just unsure, right? They weren't necessarily in jeopardy of foreclosing. I haven't run across that situation, but as long as you bring it current before let's say for example you have an investment property and you're buying a primary, and you're in escrow for that primary, but the investment is in forbearance. As long as you bring that current before the close of escrow on the primary, you're fine. If you have missed payments in forbearance, that could be a little bit of a hiccup because then you have to prove that you made, on-time payments for a little bit, for, maybe like 3 months or something like that.
Hmm.
Or if you have a loan modification, meaning that the lender gave you new terms, you have to also prove that, with the new terms, you're meeting your obligation as well. So that might take a little bit longer time. But to be honest with you, I haven't seen a situation where the forbearance has actually killed deals.
Interesting.
Yeah,
As long as they're current. So like if you went into forbearance, you can't purchase another property, which makes sense.
right, exactly. As long as you're current. So if you like have missed payments, but you got current as if the forbearance never happened, and you're on time, then you're completely fine.
Nice. Now, because I've had people ask me this, so if you go into foreclosure, it stays on your record. Does forbearance stay on your record? So if you went into forbearance, but then you're current and later on down the road you decide to buy, anything like that, does that affect you getting a loan?
I don't think so. Not for the COVID situation because there's specific requirements being met for COVID because the country knows that this is a specific time frame and not necessarily any fault of the borrower themselves. So I think there's specific rules are being put in place by the government saying during this time frame that the forbearance, you can talk to your lenders and your servicers and
Sure.
work that out. But the key to all this though is if you don't want it to look bad like on your credit report, if you're ever thinking about it, communication's key. Like getting in front of the ball is definitely key. Talking to the servicer, seeing what the options are, in order to make sure that a mistake isn't made, because that happens. We've seen that happen where somebody's gone into like a forbearance, and then it's considered a late payment, and then it was like, wait a minute, that was not what was intended. Um,
Oh,
but at the end of the day, I would say that, it's still the same thing that we talked about last time, was if you don't have to do it, definitely don't. It's a
sure.
major headache. If you can make your payments, just make the payment. If this is something that, you just can't avoid, then, the golden rule is open communication, don't hide
Just kind of is
anything.
what it is.
Exactly, exactly.
Got it. Okay. What, so shifting gears a little bit, what should buyers who are looking to get a loan right now, what should they be doing? What should they be looking out for? Is there, what should they be, what are the first steps, especially for like a first time home buyer who has no idea what they're doing?
Yeah, for sure. I mean, I think that nothing really has changed in terms of that. Usually, they'll reach out to a guy like you, Rick, to see, hey, I'm looking for a home, 3 bed, 2 baths, range 650, single family residence, right? And then the step process remains exactly the same. So, we'll get in touch, with the lender. The lender will pre-qual them or pre-approve them, gather all the documents. And I would say, because of COVID, if you're a salary person, it shouldn't be a big deal. 24-hour turnaround as long as you get the documents and application. For self-employed, that may take a little longer because then we got to audit, some more things. But same thing, I would say. And then once that pre-approval letter comes in, it's your golden ticket into the market. So it was actually, running into a question maybe I was going to ask you, Rick, about open houses, right? Or
Yeah.
I've heard that you can't sometimes even access the open house until you have that pre-approval letter in hand. Is that correct?
Yeah, so that does happen. On occasion, we actually required it for one of our listings. Um, so for example, I had a listing in Ladera Heights. It was a condo, and it was right after they basically said, now you can do showings. So we said, great. But because it was very close, we had tenants living there. We wanted to make sure that if anyone's going to come through, that they're serious and that they could write an offer on the spot if they wanted to. So yes, in some cases, listing agents are requiring the pre-approvals ahead of time.
Perfect. Yeah, that's what we're seeing too. Is that we're getting more requests for kind of like generic pre-approval letters. Um, and yeah, I would say for the most part though, everything remains the same. Pre-approval, get in touch with your agent. They'll get you in touch with the lender. You get the pre-approval. That's the golden ticket. Go see your homes. Put the offer in. Once the offer gets in, then it's up to us to get it done.
Right. That makes sense. So let's say you're in a buyer's position. What strategies would you be doing right now?
Um, you know, there's a lot of I think that, buyers right now are maybe a little concerned, right, about down payment versus mortgage payment and things like that. A good lender is going to walk them through all the different combinations because, you know, no two borrowers are exactly the same.
Right.
Some have more assets, some have more money. I know people who I pre-approved, they make 1.5 million a year. They can't buy that much because they have too much on their credit report. Versus somebody who makes essentially less, but they may have more cash and they have no debt and they're able to even buy something even more expensive than the former person. So everybody's credit profile is different. So just being, I think, honest with the agents and then the loan officer. The last thing you want, to be honest with you, is to not tell a lender, I had like a foreclosure in the past, or I'm in forbearance with the property I own right now, or I'm on title, or like I just inherited a property that's not on my credit report, but I didn't tell you about that. So you want to be
'Cause
sure.
everything's gonna come out.
What's that?
Everything's gonna come out.
Exactly. Yeah. Everybody wonders why it takes so long to get a loan. It's because there's massive checks that occur. That's a lot of money for a lot of people on the line. So they do a lot of background checks. They'll figure it out eventually. It's very rare that something slips.
Sure.
That doesn't happen.
Okay. Are there any major changes to some of the more common programs? I know you said for the most part it's, stay the course, but in terms of FHA or some of the construction loans, which we'll get into here in a little bit. Has there been any major changes to the programs themselves?
No, I mean, not changes that I think a borrower has to concern themselves about. Things that lenders have to concern themselves about, yeah, definitely. There's things in the background that honestly, like me as a lender, like you're stressed out as a borrower. Like we know that, like it's a big financial transaction in your life, right? You know, you're talking to not only your buyer's agent, you're trying to put offers in, all those things, right? So there's certain things that I wouldn't want to bother a borrower with. But for example, like FHA, um, FHA has different reserve requirements now. Now, what are reserves? Reserves is money left over after the transaction closes that have to be in your bank account to show that if something were to happen, you have some time to make a payment if you didn't have cash flow into your personal life, right? So that's not necessarily something that I would tell a borrower unless it was a problem. I would say, hey, I don't think you have enough reserves at this point. But if they do have the reserves, I probably wouldn't even mention it just because it makes people nervous, I guess to say. Yeah, I mean,
You don't want to worry them over something that they already qualify for.
exactly. And then, you know, when I issue a pre-approval letter, if they're like on the fence, so like, you know, what lenders do is we draw a box, and that box is basically very big or very small, depending upon the credit profile of that person, right? The bigger the box, the easier it is to qualify. The smaller the box, the more we're trying to get to the edges to get you to where your goal is. So if you're trying to qualify for a $500,000 home and you're at like 480, we can push it. We can push it by saying, hey, this combination of cash, this down payment, this monthly payment, and this rate, and this debt payoff, in the perfect world, that combination is the combination that gets you to 500, right? So if you're at a pre-approval stage and if you're trying to push it like that, then that's the only time I'd probably say, hey, listen, it's got to happen in this specific way, because if anything falls out of line, if you pick up a couch or something and you finance even $25 a month, like the loan won't go through. So like I'll make sure that they understand the risks involved of trying to push, right? If you're not trying to push, you're well within the means, then there's not a big deal. But
Sure.
yeah, that's what we do, is like we try to leverage every possible scenario there is in order to get you to your goal. Sometimes the goal can be met and sometimes it can't be met.
Right. Now, backtracking a little bit, you mentioned a pre-qualification letter versus pre-approval letter. Can you go into detail on what's the difference and why it's so important to have one over the other?
Well, we issue pre-approval letters. It's really just us looking at, doing our due diligence in terms of making sure that we think at an 80%, 85% solution that the loan will go through. So here's the thing: is I guess
you're talking about solution, you're talking about the loan to value.
Oh no, I'm talking about the confidence that the loan will go through.
Got it.
So, like I said, during an escrow, all those background checks occur, right? Other mortgages, was your bonus income exactly what we thought it was, type of thing. They do written verification of employment. They'll call the employer right before close and make sure you still have a job. We'll get a pay stub right before close just to make sure you still have your job, type of thing. So all those background checks that are occurring are you can't do during a pre-approval process. But as long as you're honest with your loan officer from the very beginning, everything will be fine. But if there's something that we didn't know about, like we didn't know, like on 2019 tax returns, there was no property on Schedule E on assets owned or real estate owned. But then like in April of 2020, you just bought a new house, but it wasn't disclosed to us. Well, that is a major problem. That actually happened to me. Was a guy's like, oh yeah, I inherited a home from my yeah, I inherited a home. I'm like, wait a minute. What do you mean inherited a home? So he actually gave me a mortgage statement and all that stuff, and thank goodness his ratios were super loose, that he could absorb it all.
Right.
Yeah, so that's kind of where we're at. So yeah, pre-approval is going to be us doing our due diligence to make sure that the borrower is good.
Okay. And that all makes sense. So I'm going to ask one last question, but in the meantime, if anyone has a question for John, feel free to put it in the chat. I do see one question there about the general housing market. We will get to that. But if anyone has any questions, feel free to type it there. So the last question I have for you, somewhat of a personal one, primarily because I have a lot of buyers that have been asking, is you have these accessory dwelling units. And yeah, they're sometimes can be challenging in terms of the appraisal and all that, but I have clients who want to say, fine, I'm going to build it myself, but to come up with the down payment and the money to build it out can be difficult. So the most common construction loan program is the FHA 203K loan, which, 3.5% down. That's the program I did to build out mine. Are there any other programs out there for home borrowers? Because they want a house hack, right? They want to be able to leverage some of that extra income. Are there any programs out there besides that?
No, I wouldn't say so. The only two alternatives that I could give you besides what you did, Rick, is one is if it's not too expensive, you can take a HELOC out, which is a home equity line of credit. It literally is a credit card for your home. It's exactly like a credit card, and like you get pre-approved to say, oh, your credit line is good up to 150,000, and
Sure.
you use like a credit card, you take out 150K, or you draw. It's called drawing. You can draw all 150, or you can draw 75. It doesn't matter as long as you're within that limit. And then it's basically cash you can get into your hands. The second option is just to do a cash out refi, depending upon how much equity you have in your home. If you have enough equity, then you can take up to 75% of the loan to value of your home, meaning in opposite terms, you have to leave 25% of equity in your home. So if you have, 30% equity in your home because you owned it for a little bit, you made your mortgage payments, the value has increased, you can take 5% out and use it towards that build. So the question is I get this a lot actually. It's a really good question. Like what's better, a HELOC or a cash out refi? And the answer is never easy. It depends. If to be honest with you, like if you have a super awesome rate, it's like 2.5% on your first, and you only need like 75K, probably go with the HELOC, right? If you need a ton of money, like 250K to do whatever you want to do, and your rate's not super great, anyways, right now, because rates are so low, anyways, you might as well just do a cash out refi then.
Right. That's what I did on my condo. Is I did the line of credit because my first was at 3.375%, which is super low even at that time. This was 2018. So it just made sense to get the HELOC instead and keep that low rate.
Exactly, yeah. And a good lender is going to tell you the pros and cons to each. A HELOC is going to command a higher rate. It's going to be variable. It's going to be able to move with the market. But
it can be good and bad.
Exactly.
It's good. Work in your favor.
Perfect. Yeah, you're exactly right. It could work in your favor. Absolutely. And you only pay interest on the debt that's outstanding. So if you take 75K out and you inherit 75K and you pay it down, you don't pay any interest on it. But the rate's higher. So versus a straight up cash out refi, which is, just one payment as you normally would, business as usual type of thing.
That makes sense. Okay. Well, we don't have any questions for John. And again, if you have questions later on for him, feel free to put it in there. We're going to address everything. But now we're going to kind of flip roles here and have John ask me.
Oh, actually, I think there is a comment. I think from NK to.
Yes, that's about the housing market. Which.
Okay, about how. Okay, why don't you answer that question first then? Yeah.
Okay. Well, in terms of, it says, so can you comment on the housing market for like below 1 million, 1 to 2 million, 2 to 3 million, and like over 3 million? Definitely kind of, it varies depending on the location of the property. So what do I mean by that? For example, anything below 1 million right now, for the most part, is flying off the shelves. I mean, I've talked to agents that are getting 30, 40 offers on their properties. On our last 3 listings, we received anywhere from 2 to 4 offers, which I'm okay with, right? I don't need all the paperwork, but my client still got the best price, still got over asking, all that. So that's still happening. The 1 to 2 million market is actually an introductory price point for some parts of LA.
Wow.
Yeah, so it really just depends, right? I mean, you go, by Miracle Mile area, and some of those teardowns go for 1 million or more. But you start going into areas like some parts of the Northern Valley, where having homes over 1 million, it's a luxury price, right? So sometimes those do take a little bit longer because we are seeing some luxury homes lagging in some cases, right? Not all of them are flying off the shelves. So really, I would say anything below 2 million is considered a introductory price point. Those are doing really well. And we'll go into the inventory here in a second. Anything from we'll call it really 2 to 5 million. Some are doing really well, some aren't. It really is property specific. And then anything over 3 million, or anything over 5 million to 10 million, 15 million, you start to get into a different world. So sometimes those take a little bit longer, right? The air gets just a little bit thinner in terms of the buyer pool. But again, it really just depends on the neighborhood, right? So hopefully they can kind of answer it. If you have a specific property in mind, I'm happy to talk to you off the call about that. So go ahead.
So yeah, for I guess Rick, what do you see in terms of home prices? Do you see them increasing, decreasing? Maybe that's not an easy answer to question to answer.
Let me just bring out the crystal ball.
Yeah, exactly.
So the short answer is that it's hard to tell because we don't know how long this is going to last. What we are seeing is, in general, the market's still doing well. Inventory is down. In the respect of right now, the month supply is at 3 months. Actually, let me bring that up so you can kind of get an idea. Oh, there we go. There we go. So right now, the inventory is about 3 months. You can see that kind of at the peak right here. So inventory has gone up a little bit. But what does the month supply mean and why does it matter? Well, basically it says if no new homes came to the market, it would only take 3 months for all the inventory to sell, which is fast. Anything below 6 months is considered to be a seller's market. Anything above 6 months is considered to be a buyer's market. What we are seeing that is very, I think, unique to today's situation and everything going on with COVID is because people don't have to be near their office anymore. They can work from home. So a lot of the more condensed areas, a lot of those people want to leave and go somewhere where they can actually have a yard, maybe an extra bedroom, right? So where are we seeing higher inventory? Downtown LA, for example. The month supply there is at 9.7, meaning
Wow.
it's definitely a buyer's market. And part of that makes sense, right? People worked over there. So they needed to be close to the office because they didn't want to deal with the LA traffic. Now they can work from home. For the same price, they could sell that. They could move to the valley or move somewhere else and get a full house, right? For some of these home prices. So, but then you take, for example, Granada Hills, right, which is the northern San Fernando Valley. That's at 1.9 right now. I mean, they can't even last less than 60 days, and they're sold.
Wow.
Right? Take parts of like Tarzana, just slightly below 3 months. So it varies. The affordable market, the affordable price points are continuing to do well. You also have household formation, right? Millennials are getting older, they're getting married, some are having kids. So it's just a natural progression to go into the next step. So yeah, that kind of answers kind of what we're seeing right now.
This is going to be a tough one. So the winter market is usually the market that is going to basically slow down in typical time frames. How do you see that playing out with what you're seeing now?
I think a better question is because that's election season.
Oh yeah, you're absolutely right.
So, typically, yes, the market slows down during the holiday season. We don't necessarily see major price reductions, if any, during those times, but it definitely generally slows down. People just don't want to move during the holidays. So backtracking and see what happens during election season. similar is what we've seen. I remember when we had listings during the midterm elections, what was it, last year, kind of the year before, and everyone was freaking out like, well, I don't want to buy anything because I want to see what happens. So it slowed things down. And then just like prior elections, the elections would happen and everyone's like, oh, the sky didn't fall. And I go right back to what I'm doing. You know, they did the same, they did a similar study out of New York for all those co-ops, historically, not right now, definitely a different world right now in Manhattan. For those who don't know, there's a lot of like almost like a mass exodus leaving Manhattan because they don't need to be there, but also more importantly, for a lot of like, they don't want to touch the same buttons as someone else may have, right? If one person contracts COVID, it can spread quickly. At least that's what I've been reading. So a lot of them are moving to the suburbs. But for here in LA, you know, typically during the election time, and what that study showed was there'd be a slowdown and then everything went right back to normal. Typically
Yeah. And to comment upon the election thing too, like that's obviously going to affect rates as well. And
Yeah.
Me barring
Good
any
point.
opinion about any political
Yeah.
candidate, there's predictions about how that will play out, whether or not rates will increase if Trump will stay or be kicked out, or if he stays in, if it'll be better for the economy. So you're exactly right, Rick. I think that election unknown is probably the biggest besides COVID. That question, is going to affect a lot of different things for sure. So back to, you kind of alluded to this too about how people are kind of on the fence as well. I get this question all the time. People ask me, hey, they're like, hey John, just give me an honest answer. Should I buy now or should I just wait? What do you say to when you get that question? Or do you get that question often, or is that
all the time?
Okay.
All the time. Which is why I always have to like do the research and be like, okay, I want to give them an honest answer. So here's my honest answer. The first question I ask is, how long do you plan on owning the property? That's always kind of the first thing, because if you want to assume that the market goes down, it's just a paper loss. It doesn't really mean you've lost anything, especially because you have to pay your mortgage or you're paying rent, like either way. So what I tell people is one of two things. I say, you might as well buy now because interest rates are super low and you're building equity and you're paying rent, right? You're paying one way or another because you have to have a roof over your head. If you're not quite ready to buy today because you don't have the down payment, anything like that, kind of what we talked about before, during the election season, it can tend to slow down. So if you're like, hey, I want to set a goal when to buy during the election season, not after. If you wait till after, by then people realize the sky didn't fall in most cases, and then everything goes back to normal, because the name of the game is competition right now. That's really what buyers need to start thinking about. And one of the biggest things, and I know you and I've talked about this before, is don't focus on the price, focus on your payments. We live our lives on a month-to-month basis, right? We pay our rent on a month-to-month basis. We get paid every 2 weeks. So the same should apply to our mortgage. So, another example could be, let's say you're looking to spend, 400,000 or 500,000 on a house, and you're paying $2,000 a month right now in rent, and you wait a year from now, and okay, let's say the market dropped 5%, so let's call it 20 to 25,000, but you just spent $24,000 in rent. So it really became a wash. You didn't get that steal that you were hoping for. As a matter of fact, you could argue you lost more money because you didn't get the tax write-offs, because you didn't build equity, anything like that. So hopefully I know it's kind of a long-winded answer, but I hope that kind of answers the question.
Yeah, definitely. And when people ask me that question too, in general, like in my honest opinion too, I ask them, I mean, because I'm licensed in California, it's usually LA where I'm getting the, the market is. But, I say, to be honest with you, if you were, in South Bend, Indiana, maybe it's not a great time to do it. You might be on the fence. But in Los Angeles, particularly, it's a pretty resilient market. I feel like prices don't really dip, if they dip at all. And usually, as you're making a mortgage payment, you're building that equity month to month. Every payment, you know, a little bit and a little bit more is building towards equity, while as rent, you're basically just, flushing it down the toilet every single month. You're not building any kind of equity. And really what's important about real estate, especially in LA, I feel like, is time of ownership. Because the longer you own it, the more equity you're building, and usually the price is going to increase in general across a long spot. Maybe not a micro level, but at a macro
Right.
level, it's going to generally increase. So that's, yeah, I definitely, and that advice is limited to Los Angeles and Ventura and Orange County for sure.
Yeah. I mean, even if you take a look at the last 5 recessions, only twice have we seen price reductions. Once was in 2008, but a lot of that had to do with giving loans out to anyone with a pulse. And then there was a slight dip, I believe, in the early 2000s, kind of like during the dot-com boom, or bust, I should say. And prices dropped on average nationwide about 1.9%. So I don't even know if people really felt it. Um, so that's just what's happened historically. So if history is going to repeat itself, that's kind of what we're seeing. In terms of foreclosures coming up, and you'll probably obviously know more than I will, but my understanding is if someone's struggling to pay their mortgage because of COVID, they go into forbearance. That can be for up to 6 months. Then they could ask for an extension of like another 6 months. So now we're a year out. Then at that point, 90% of homes, this is across the country, have at least 10% equity. So that means they could sell at any point and still come out ahead and not have a foreclosure on their record. And if they want to say, screw it, I want to go into foreclosure, then that's another minimum of 90 days. So now you're talking a year and a half out before we see even like the first foreclosure. I don't know if that is, am I on track with that?
Yeah, sounds about right.
Yeah. We do have a question here. Do you observe any cities in LA or Orange County are particularly blooming in house prices? From my end, I'm seeing it more in the lower price points, the more affordable, because there's a bigger pool of buyers. And and to what John mentioned earlier, because interest rates are so low, it allows people to afford a higher price point. John, does that sound about right? From what
Yeah,
you're saying?
absolutely.
Yeah. Okay.
Yeah, absolutely.
We have another one from a past client of mine. Can you comment on the looming eviction crisis and how it might affect property prices if vacant rental units flood the market? That is definitely an interesting one. So LA Times just reported that they are seeing some issues in the rental market, but they're specific to the luxury market. And again, I think that kind of goes to what we were talking about earlier with not everyone has to live in downtown LA anymore. And that's usually where the higher prices are. I think it's going to come down to the relationship between the tenant and the landlord, right? If they have a good relationship with them, they might be able to work something out rather than have to go straight into the eviction process. How that affect property prices? That really affects like multifamily, ones that are more analytical in terms of the values based off the rents. So you might see some there, but in terms of single family homes or homes with ADUs, because there is a bigger pool of buyers, again, I can't predict the future, and I know John can't either. I just don't see why they would necessarily affect it. And there's, again, just like even with on the purchase side, there's still such a low inventory of rental units. So even if twice as many rentals come on the market, it may not even still may not be enough to fill in demand. So, and then those people that got evicted still have to go somewhere. So it's almost like you're just shuffling them around.
Sounds good.
Yeah, I don't know if you have anything to comment. I know you're more on the mortgage side, but I don't know if you've had conversations with investors, anything like that about that.
No, we had a borrower who was almost closing on an investment property, like a 4-unit, and he backed out, right, because it was like in the beginning, it was like May time frame type of thing, and he just backed out because he was afraid about it. But no, to be honest with you, that's kind of a rare thing. People are still buying investment properties. People are still buying primaries. People are still selling their primaries to buy other primaries. There's, I feel like, to be honest with you, it's still really strong. I feel like, I mean, I was working sometimes, 12 hours in the office because there was just so much going on. Like, it's kind of nuts. It's kind of nuts that we're in a, COVID crisis mode and so much money is moving back and forth
Mhm.
between people.
And the other thing to keep in mind is the cities and counties are providing resources for tenants. So, for example, LA County, not for those in the city of LA, but they are providing some form of housing assistance for those tenants that qualify, and those checks get written out directly to the landlord. So there are different ways you can work with the tenants to avoid those evictions, because it's it's no fun for anyone. It's not fun for the tenant. It's not fun for the landlord. So to the government's credit, they are trying to figure out ways to kind of help subsidize um, the lack of rent payments.
So Rick, you and I talk about this a lot. So this should be not a. I'm not gonna rack your brain on this one. Because of the supply issues going on, are you seeing more competitive bids? And then what are the things you can do to try to help someone win that bid?
Sure. So as someone that was one of 17 offers when I
Oh my,
bought
geez.
when I bought my place, when my wife and I bought it, I can definitely attest to that. So yes, a lot of multiple offers are going out there. So what can you do? There's a couple strategies that we do with our team. One of which is we do look at age listings, right? So, for example, and John and I worked with a client recently. It was actually on a townhouse where it was on the market for 19 days. And so I reached out to my client and said, look, that's considered an aged listing. So let's go after it. And sure enough, we were able to get it, no competition, below the list price, um, right? Because I think that some sellers, because they see that it's such a hot market, they think they can ask anything. But buyers are not stupid. There's so much data out there for them to be like, okay, is this even a good price? And then appraisers, back in 2008, and correct me if I'm wrong, but lenders could go to an appraiser and say, hey, look, I know it can only appraise for 400, but we need it to appraise for 450. Can you do it? And if the appraiser says no, you go find another appraiser that will. Nowadays, you can't do that.
Yeah, I can't even talk to an appraiser. I have to go through a website and say, tell the appraiser, please, the price was reduced to X amount, and then I get a message back saying, okay, message sent.
Yeah. But what are some other strategies you can do? Honestly, writing a personal letter actually can help. It doesn't cost you anything. We had a client, he was one of 5 offers, and we were actually the second lowest. But because of the personal letter, that actually really helped.
Wow.
They're like, my clients just liked your buyer. And I was like, okay, who am I to say no? If the name of the game is price, what we did on our home was we actually did an escalation clause. So we said, I believe it was $1,500 above any bona fide offer.
Wow.
So most people do a cap, and so it's like, okay, you're at 400, and I'll do $1,500 above any bona fide offer up to 450. In our case, we didn't put a cap on it, and the reason being is because we knew that it had to appraise. So we had a chance to renegotiate the price if we had to. So what's the risk with that? Well, if the seller tells you to go pound sand, then you lose out on the inspection money, the appraisal, maybe some escrow fees. So you are risking a few $1,000s by doing it, but those are some creative solutions, right? And then even then it can be terms. It could be free rent back, right? In our case, we gave our seller 30 days free to live in the house after the close of escrow, because we were going to do an extensive remodel and do the garage conversion. So we couldn't touch the house for 30 days anyways. We had to get the plans approved and all that. So it didn't cost us anything to have him be there, but it gave us a leg up above anyone else. So you just have to get creative, and every situation's different.
Yeah, and on the loan side, sometimes Rick and I have conversations like this as well as, what can we do on the loan side to make sure,
Oh yeah.
that it can get accepted. And usually it comes down to time is usually what it is. I would say for, if you really want to push, like you can really push. It's hard to push now, but I mean, in a typical environment, if you need 21 days to close, we're going to do everything in our ability to close in 21 days. If you need the appraisal within 4 days, we can super rush it and pay a fee, a premium for it. Loan contingencies, that's usually something that's usually something I get kind of scared about. I would never, because if you heard anything about this this webinar, is that things happen, right? Things change and during the process, and there's always curveballs, and sometimes the curveballs are very minute, and sometimes they're very large. So if we do our due diligence on our end, and there's full 100% communication, the ratios are super loose, that is a good conversation to have. Maybe you don't have a loan contingency because your ratios basically, when I refer to ratio, I apologize if it's not a term familiar. So, lenders, we have to make sure that every dollar that you bring in, that you have the ability to afford a payment and everything else that you have going on in your life. So whether that be student loans, credit cards, we have to take a holistic look at your income to make sure that every dollar you bring in, you have the ability to pay all those back within reason. So, yeah, not having a loan contingency may be an option if your ratios are super low, meaning for every dollar you bring in, only 20 cents of it will go towards everything in your credit report and your mortgage, and that's
Right.
like a slam dunk. Like there should be no problem whatsoever with something like that. But if you're like, we push you to like 49 cents on the dollar, that your mortgage payment will
It's a
will
different
get there.
conversation.
Yeah, yeah, that's like, I wouldn't want to risk it. I wouldn't want to risk your earnest money deposit. But you're the client. If that's something you're willing to risk, we're gonna do what you want to do, but we want to make sure that you're understanding what the risks are and what we believe will come out at the end. So
Yeah. And for those that are first-time home buyers, they're putting the 3% down, the 5% down. Typically, what we've done to help get offers accepted is, at least from an agent perspective, is we do a lot of sucking up. Like I don't know how else to word it. So we'll call up the listing agent and have those communication because we want the agent to know that if you're working, because for an agent, from a listing agent's perspective, they want two things. They do want the best price and terms for their seller, but they really also want to make sure it closes because that's how they get paid. So if they know on the other end that they're working with an agent that's like committed on top of things, knows that it's going to close, they're more likely to have those offers picked. And I've had that happen too. We were one of two offers. We were actually the lower offer. This was out in Calabasas a few years ago. And the agent's just like, you are on top of it. Like, great. We can
yeah.
make it work. So yeah, you just have to get creative. We do have two questions here. Do you observe more or less international buyers recently, especially for the housing market? I think it was at over greater than 3 million. Um, you know, we are seeing international buyers are still buying. I know it was a little tricky before, especially with COVID and shuffling money around, but from what I last read, because I deal more with local buyers, but from what I've been reading, they're still coming in from China and Canada, seems to be the two top two. Um, but if you'd like, I'm happy to get even more information and be able to send that over. But that's what I've been reading. What about you, John?
Yeah, I mean, we've had some deals come through where they are kind of like foreign nationals. I'll be honest with you, foreign national loans they're tough. They're not easy. You have to have a lot of down payment. You have to get everything translated if you're getting a loan. And that's not an easy process. And then you have to convert the currency to US dollars type of thing. And the rate's not going to be great either. So to be honest with you, I don't really deal with a lot with foreign national loans. But I feel like a lot of international buyers will come in all cash too. That yeah, it's just one of those things.
And
I,
especially for those that are been sitting on the market for a long time, and kind of the luxury market, we're seeing some homes kind of sit for a while, and so international buyers, sometimes they like that, right? They know they can get a deal, or what they
for sure.
perceive to be a deal, I should say. The next one is, are you seeing an increase in clients moving from the Bay Area as tech companies and other companies announce their employees can work virtually forever? Just wondering if that's increasing people moving to SoCal. So funny enough, I was just talking to a buddy of mine that lived here in LA, moved up to San Francisco working for Google. Then they made that announcement that they're not going back until I think July of next year. So he moved right back down
Oh, wow.
to Los Angeles, because Los Angeles is less expensive than San Francisco. As expensive as LA is perceived to be, we're actually one of the least expensive of the major cities. I wouldn't be surprised if we see that, right? I mean, with everyone going virtual, why not live anywhere, literally in the world at that point? So I wouldn't be surprised. It'd be interesting to see if you have a lot of, let's say, for example, I'm from the Midwest and I had to move out here because of my job, but now I don't have to, and they're okay with moving back home. That might be kind of interesting, making 6 figures and living in the Midwest. You can live like a king. So that might be kind of interesting to see as well. Because I know areas like Salt Lake City are really growing. Austin has a big tech community. So we're seeing a lot of that as well. Okay, anything else? I think, does anyone have any questions? John, do you have any questions?
No,
Close to the hour mark here.
I think I racked you enough over the coals.
Likewise.
Yeah.
So again, for those, thank you for hopping on the call. We'll be posting this online because it is being recorded. The intention for us is to do this on a quarterly basis. So we really love your input on what you liked, didn't like, what would you like to see going forward. John, if anyone needs to get a hold of you, how should they do it?
Oh yeah. You know, I'm always available. My cell phone. I'll write it in the message box here, and then my email. I always check. I'm always available 24/7. So that's not a problem for me.
Great. And then for me, I'm going to send everyone a thank you email. So you guys will have my contact information. And then I'll also put it kind of at the bottom of the screen when I post this online. In terms of social media, in case you do go on there, you can follow me at Rick B. Albert, or you can follow the company I work with at L'America Homes. We post some amazing properties and some fun stuff there. So if you guys need anything otherwise, thank you so much, John, for doing this. Always a pleasure.
Always a pleasure.
I'll talk to everyone soon. You guys all have a great day.
I appreciate it.
Thanks.
Nice job, Rick.